Good evening, everyone. This is the first of two videos plus a write-up I'll send out over the course of October that will make up the content for what would have been the 2020 annual investor meeting for Islamorada Investment Management, if not for coronavirus. I will also include some slides from Loretta Reeves here at IIM on her international portfolios in an email later this month as well. I'm calling this first video the big picture. First, and real quick as always, our lawyer says hi. Feel free to pause and read that as you see fit, but I'm going to keep moving on here. The agenda for this video. We are going to spend some time on COVID in these slides. The coronavirus is the elephant in the room when it comes to the market in 2020, and for another quarter or two at least. And to not discuss it at all probably borders on some kind of advisory malpractice. The big picture I'm trying to get at, and what I'll talk more about in a minute on COVID, is basically, is there hope the whole economy will get better, or do we need to wait for a vaccine for that to happen? And the short answer is yes, there may be some reasons to be hopeful in spite of a lot of headlines of late. So we'll talk through that first. Then we'll hit the U.S. economy briefly, and then finally the election. So in other words, we're going to hit all the three big pain points for most investors of late here tonight. The next video after this one will drill down a bit more on energy and the Tarpon folio and Gecko too, for those of you invested there. And then I'll put out another email in a few more weeks after that with a closer look at one of our newer companies in Tarpon. The energy sector has been hammered during COVID this year, and though I'm as bullish as I've ever been on Tarpon and Gecko, very bruised but very bullish, that also merits a whole separate discussion. So energy and the Tarpon folio is not on the agenda here in this first video, but we will get into it in much more detail in the next video out in a few more weeks. I also kind of think building a top-down case for energy companies in 2021 starts with these same three macro topics above here in this agenda. So hopefully the flow seems logical to you. For now, though, given COVID and then the upcoming election, which is going to be one of the most contentious and consequential in a long time, and then the general volatility in the market in 2020 so far, want to start at a high level tonight and then work our way down the portfolio level with some additional thoughts in some other content over the next few weeks. First, then, the novel coronavirus. Feels like COVID has been the black dog hanging over every day in 2020 since February, but I do think it's real important to try and take some of the emotion out of it when it comes to investing in particular. And to remember that this thing won't be here forever, even if it feels like it already has been. So let's get into it. Here is the ongoing spread of COVID-19 around the world. At the moment, cases continue to rise, but at a slower pace than earlier. The short version of this slide is that many cities and other parts of the world obviously continue to face challenges due to the infectiousness, of the disease. In the U.S., the coronavirus is still spreading rapidly across many parts of the country, which means the continued public health response will determine how steep or how flat the curve will be from here on out. This sort of chart will also determine how quickly the economy can recover and whether there might be a second wave. To be clear, there's a whole nother slide deck we could do when it comes to hospitalizations versus cases, comorbidities, and who is most at risk, those sorts of things. But in terms of market sentiment, cases are still clearly the driver of that for now. Some more Johns Hopkins data, only here it's graphed using a 5-day simple moving average, which basically adds up the 5 most recent daily numbers and divides it by 5 to create a new average each day and then you connect each average to the next one to create a single line. I only mention it because that 5-day hack is very fast moving and emphasizes very short-term trends. You can see the coronavirus confirmed case numbers sawing higher in the rest of the world over the last month or so. So it's still spreading around the world, though U.S. new daily cases are flatter now than earlier this year. And this data, by the way, is all through last Friday, October 2nd. So the public health response has controlled the virus in many places, but it's still spreading around the globe. One final look here at the U.S. data, this time using a logarithmic scale to highlight rates of change. So stepping back for a second, you want to use a logarithmic graph for big data sets, whether you're really trying to highlight, when you're really trying to highlight any significant changes to a trend, whether that's up or down. If you watch the evening news, you'll often see a linear scale version of this kind of chart, not a log version. And that linear look will show a more dramatic looking exponential curve to these case numbers. That sort of thing it's a bit ingenuous, though, at least in my mind, because we already know cases are going to keep going up. That's just how addition on a graph looks. What we really want to care about, though, is changes to the recent trends in cases in particular, again, when it comes to investor sentiment, really. So that sort of thing is one of a number of pet peeves of mine when the media is talking about this virus. But, in any event, what we're showing here is that while COVID-19 cases continue to rise across the U.S., the pace of growth has slowed since the first wave began in March. The death rate has decelerated too, which is important, even though it tragically remains high in absolute terms. Really want to draw your attention to the slope of yellow line there, though. Second from the bottom on the right-hand side, on recoveries specifically. Analytically speaking, that, to me, anyway, is the most intriguing data point, the most intriguing question in all these sorts of slides. Specifically, what is leading to continued growth in the number of people recovering from this thing? It can't be just social distancing and masks, because that line for cases right above it then would probably be, parallel to narrowing, right? And we're not yet scaling up mass treatments, let alone vaccines, at the scale that the slope of that line would imply when you think about it. So while there could be a number of reasons, or a combination of a number of reasons, that explains the slope of that yellow line for recoveries, my hunch is that it may be more based on this. The super spreader hypothesis. I think that super spreader term suddenly got popular this weekend after President Trump tested positive for the virus. And I do want to note the word hypothesis in there. To be clear, I have zero expertise in epidemiology. I do have a little bit of experience, though, with statistics and simple models in general. And this super spreader model seems worthy of more attention to me for what it could mean for the economy specifically. I'll leave it to the CDC to figure out what, if anything, it means for public health. But the whole idea, and by the way, this is not my idea, it's coming from epidemiologists at places like Johns Hopkins, but the idea is that if you try to reconcile the various things we're seeing in COVID data all over the world with an explanation of how this thing is spreading, we, scientists, may be in the process of discovering that it's actually a small percent of infected people that may be driving an outsized percent of cases in certain specific types of situations. So, early on, what they call the homogeneous models, or the default models, as per that very simple little graphic here on the left-hand side, that assumed COVID was super contagious and everyone who caught it. Those default models were really all about how many other people one infected person on average could infect. You may remember seeing or hearing the term R naught. It looks like R sub-zero when it's written out on the screen. And that R naught is the measure of how contagious the virus would be. One issue that's come up now, though, in the modeling sense, is that those early estimates pegged R naught as being in the 2 to 3 range. Yet now it's looking more like that was overestimated. In other words, not everyone has the same degree of contagiousness, and the average level of contagiousness across all infected people appears to be significantly lower than first believed also. To be clear, I think that's probably a good thing when it comes to the initial public health response. When we don't know what we're dealing with, it's probably wise to overestimate that factor early on and act appropriately. But to some extent, that's also more in the public health discussion, separate from the modeling specifically. The point here is that if it were true that one infected individual would subsequently infect between 2 and 3 other individuals, if that R naught was 2 or 3, then the growth in COVID, as it turns out, would have been much more rapid than it has been since early on. Well, okay, why didn't that happen? Why didn't growth go as fast as it might have been expected given that initial R naught estimate? Well, that could be due to social distancing and masks that help slow that spread. But some of the modelers are also now theorizing that it might be because the vast majority of transmission is due to a few super spreading people or events, while the vast majority of infected individuals do not actually transmit the virus. So what does that mean? It means two things, at least. The first one that jumps out at me is that if we can identify the specific circumstances when super spreading is most likely to occur, this whole thing becomes easier to control without having a blanket lockdown of the economy. If you assume everyone is equally and highly infectious, then lockdown is the best way to squelch the spread. Just throw a blanket on the whole country. But if it turns out that it's really a small number of super spreaders who are, as the epidemiologists say, over dispersing this thing, then the way to contain it is less about lockdown and then much more about identifying the circumstances when super spreading is most likely to occur, and then preventing that. So less fear, less economic loss when you don't go, for instance, to the dry cleaners like you usually would, as long as we skip the Taylor Swift concerts for a while, that sort of thing. Which, and this is the key part, which would be a much more targeted approach to slowing the growth of this virus at a much lower economic cost. And again, I'm not trying to be cavalier at all about the public health impacts, but what I am saying is in terms of what I'm trying to emphasize anyways, in terms of the economy and by extension the market. The second point here is arguably probably more important than that first one. Super spreader models, and there's a number of them, but they produce some positive conclusions about the course of this COVID-19 pandemic from right around here on out. And each different super spreader model ends up having one big core conclusion in common, which is that the percentage of population that would need to become infected in order to reach the herd immunity threshold, or the HIT, as is on these graphs here, that is much lower than the 60% level commonly predicted by those older homogeneous modules. The older models we started hearing about in March, which do not factor in super spreading. The reason that herd immunity threshold is much lower here is because if those models are accurate, then it's really only the super spreaders who would need to develop immunity in order for the population as a whole to reach herd immunity, if that makes sense. So if these newer super spreader models are more accurate, then in theory, the U.S. Would be reaching the herd immunity threshold earlier than expected, like perhaps right around now, give or take a few weeks, and given some of these models. We'll be able to kind of test that hypothesis real time by watching new cases, hospitalizations as well, both of which should decline sharply, right? Once we are at that herd immunity threshold, though, I guess I would note that deaths that are reported also tend to lag by about 3 weeks or so. In any case, though, the point is that there is good data showing up now saying that roughly 80% of new infections are spread by fewer than 20% of the infected population, which, when you combine it with the pattern of these new cases emerging, that's both here in the U.S. and overseas, seems to be a pretty clear indication that super spreading is going on. And then if so, it follows that it needs to be accounted for in the models that are driving the state's decision on the response to this thing. And that's a capital S in state there, by the way, as in the government's response. So if super spreaders are in fact the big driver of how this coronavirus is being transmitted, then in the economic sense, it means, number one, even the most impacted parts of the economy should bounce back sooner than expected. Malls, airlines, restaurants, energy, etc. And then it also means, number two, there would be a middle ground between the alternatives being offered by both political parties at the moment. Somewhere between total lockdown on one side and then not needing to wear a mask anywhere on the other side. This would mean there is a literal middle ground that would be effective and not super costly, if this proves to be true. I've also included some other sources in there for more reading on super spreader models if you're curious. It's easy to go down the rabbit hole, but I do recommend them if you get the time. Also should clarify that those models don't each say that the new herd immunity threshold under super spreaders is exactly at that 18% in that blue line there. But I think that level was actually from the first one, that Rose study. But the point is, estimates from all those papers do range from below 10% to as high as 43%, all of which underscores the point that we would reach herd immunity as a country at a much lower threshold than the 60% that is really the consensus right now. All right, enough on wonky models. Let's talk real quick about vaccines. When it comes to the question of when we will get a vaccine, I don't have much unique insight into the timing on the therapies, except to say that they are coming fast. There are now several hundred vaccines for COVID in development around the world, with about 3 dozen currently in clinical trials. Testing and producing a vaccine, as you probably understand, is a very complex process, a lot of uncertainties. But the best guess now, at least the experts say, is this. If every aspect of the vaccine's development and distribution goes exactly as planned, and history has shown that rarely happens, but if it does, then certain people in high-risk groups could get vaccinated this year. Most other Americans, however, will still quite likely have to wait until well into next year to see a vaccine. Of the 3 companies with vaccines in late-stage clinical trials in the U.S., just one of them, Pfizer, has said that it could have initial results back in November, but maybe. They were originally saying October, but they recently pushed that back. The other two companies, Moderna and AstraZeneca, have been a little bit more vague on timing, saying only that they hope for results before the end of the year. Also, it's worth noting that so far, both Pfizer and Moderna's vaccines appear to have shown some efficacy, though also with some side effects. So, when will a vaccine be available to any American who wants it? The best guessed range from scientists, investors, and health officials is the first half of next year, the first half of 2021. Stay tuned. When it comes to COVID, though, which is sort of the broader point, there is a light at the end of this tunnel. Look, we're going to figure this thing out, and by me, I mean we American scientists and Europeans too, I should add. Even if this super spreader hypothesis ends up being widely incorrect, the people with diplomas that say things on them like statistics, specializing in mathematical epidemiology, they are getting better at figuring this thing out every day. It is going to take time, but hang in there. There are increasingly more likely scenarios developing when things get better even before vaccines arrive. And as that light in that tunnel gets bigger and bigger in 2021, the more the economy will accelerate in terms of growth as people start getting out and spending again. And then the more the market is likely to rotate out of some of the high-flying darlings of this pandemic period and into what should be the real darlings of the recovery. Energy being a prime contender there in my mind, though I'll talk more about that in a later video. So to sum all this up, I think it's rational to presume that the world economy will continue to recover rapidly from the coronavirus. Global GDP right now is made up 2/3 of the 20% drop we saw earlier this year, and it should continue to rebound as the world adapts to the virus with lower cost things like masks and social distancing, and as monetary and fiscal policy remain supportive. The trajectory of the spread remains uncertain in the short term here, but vaccines are on the way, and we're getting a better handle, on the spread of this thing slowly every day. In the meantime, our own base case scenario here is assuming that the path of new infections and fatalities will not prevent a continued rebound in the U.S. economy. We expect the FDA to approve at least one safe and effective vaccine this year. And a little bit further down the road, mass vaccinations, together with the impact of prior infections, should result in herd immunity in most of the advanced world, really, over the course of 2021. Okay, time to sit back for a second here. Given all of that coronavirus angst out there, and how that is really manifesting itself in the country's politics at the moment, I think it's probably natural to wonder if whether or not you as an investor should just call a timeout and sit on the sidelines until all this dust settles. If that isn't already the most common direct question we've been getting of late, it's probably driving a lot of the other ones. I think that deep down, though, you all probably know where we are here on that sort of question. There are arguably maybe a few very specific instances where it makes sense to preemptively move portions of a portfolio to cash before an election during a global pandemic. But those reasons are really related specifically to time horizons. Otherwise, and as per those emails I've been sending out all year, it's always critical to try and separate emotions from investing. These days, it seems there is nothing more emotional than politics either, so I would extend that, right? It's important to separate those political feelings and opinions from investing also. Exhibit A of why I'm saying the optimal strategy is to hold put here, which is the folly of trying to time the market. Very simply put, staying invested when markets become volatile is a key to long-term gains. In this chart specifically, you can see the effect of exiting the market for different durations of time immediately after negative 2% down days in the market. It's pretty clear that historically this sort of thing usually results in worse performance than simply staying invested. And part of that is because deciding when to re-enter is always difficult. So while I get the impulse to want to think about maybe selling now and then waiting until after the vaccine or after the election to get back into the market, history says that for the vast majority of investors, the market may very well use that sort of thing as an opportunity to teach them an unpleasant lesson about market timing. There's also probably no better example of the importance of emotional discipline when investing than the last 6 months, really. If you'd considered sitting on the sidelines after the bear market crash that began in February, you would have missed the recovery if you'd blinked. During the third quarter of 2020, which just ended, the S&P 500 fully recovered its losses and gained 8.5%. So not only are U.S. stocks up 5.6%, including dividends, for the year, but the round trip only took 6 months. So once again, it's difficult to time the market effectively, and overreacting to short-term market developments usually backfires on you. Now, there are some important aspects of that S&P 500 outperformance this year that ought to be noted. Specifically, that it's been particularly concentrated in tech-led sectors and growth stocks. Saw a stat the other day. For instance, the Russell 1000 Growth Index has risen 23% so far year to date, while the Russell 1000 Value Index has fallen over 13%. In the next video, I'll show you a little bit more about how the concentration in the U.S. equity market is also currently the highest on record. And then among value stocks, the entire energy sector is notably lagging in that group too. And yeah, it can be particularly unpleasant and borderline galling at times to watch all these tech stocks that don't actually make very much money zoom higher every day over the summer. But there are very good reasons to ride it out in those more value-oriented stocks, including energy. But like I said, I'll unpack that a little bit more in the next video. For now, my point is that the broad stock market, over-concentrated or not, has done well this year, despite the seemingly never-ending chain of nutty events all year long. The economic recovery has been underway since cities and businesses of all sizes began to reopen in the summer, and jobs are bouncing back, as shown here. And don't forget the Fed, which is also very supportive for the market. The Fed effectively cut rates to zero earlier this year, where they are expected to stay through 2023 at the moment. This chart shows the implied rates and number of hikes and or cuts based on Fed fund futures at future Fed meetings. There's a lot going on this slide, but the point is that interest rates are at rock bottom, and Fed has no plans to send them anywhere for a couple more years. It's not to say that all areas of the economy are recovering, though. Restaurant dining is still down at about 45% now across the country. And there are 70% fewer air travelers, still. So while the short version of the macro outlook is that a lot of economic data shows a strong bounce back in many areas of the U.S. economy, including overall hiring, consumer spending, manufacturing activity, jobs. The reality is we're not there yet in those areas that have taken the hardest hit from COVID. The good news is that if you presume we're going to see the impacts of COVID lessen dramatically in 2021 due to vaccine, or possibly even earlier as our modeling of this virus gets better, then even those lagging areas should see a strong bounce. Shifting gears to the third and final part of the agenda tonight, at least, the upcoming U.S. election as relates to investing specifically. For long-suffering value investors, the quote on this slide here may sound like a bit of a tease, but it's actually not my quote. It's from Goldman Sachs, and they are basing that take on a number of factors, including that idea mentioned earlier that the broader market is very over-concentrated in tech stocks. They also foresee a large fiscal expansion coming under a Biden administration, a lift in the long end of the U.S. Treasury curve that would reduce the valuation premium in growth stocks relative to value names. Another reason Goldman believes the great rotation might be here after this election is because of higher corporate taxes should Biden get elected, which, while a possible broader risk to earnings, would also support, in their mind, a rotation back to value stocks due to a reversal in momentum in those recently higher flying growth names. And then Goldman's also citing increased risk of antitrust against the same big tech names that have been dragging the broader market higher here. If we get a majority Democratic DC. And there's also a few things like a vaccine that could also spark that shift from growth to value, regardless of who is in DC. So I thought it was a particularly intriguing take on this election, in which would be also particularly pretty good for value strategies. All of which jumped out at me. The Great Rotation is something that we've talked quite a bit about, speculated about on the message boards. I know not all of you are on there, but may have a little bit more to say in the energy video there as well. Okay, let me give you a few more sort of compare and contrast kind of slides, and then step back and speak a bit more broadly. Just note, as I sort of ratchet quickly through these next few slides, if you have specific questions on policy differences between the candidates, consensus views, or anything else related to this election, or when it comes to taxes, investing, just please reach out. We get a ton of research from independent firms, as well as from some on the street, and happy to help, of course. So I'll just kind of flash these next few slides in front of you. They are among the more common questions we get. They're almost better reference cards, so I just ask you to pause the video on each to read them more in detail as you see fit. I don't intend to read off these to you for these next few. Here are some thoughts on equities, general thoughts on stocks under different election outcome scenarios. Some thoughts on commodities. Again, we'll be talking more about energy policy too in that deeper dive on Tarpon later this month. And then the final quick snapshot of another frequent question of late when it comes to the differences in personal taxes, what those policies would look like between the two candidates. Again, we have lots of this kind of analysis, so please let me know if you'd like to see more, and I'll send it your way. Those sort of specific details on more frequently asked questions aside, let me just step back a bit here and talk bigger picture. As I'm recording this, early October 2020, The next presidential election is only a month away, and I think it's safe to say the country is as polarized as ever. Not only are the candidates very different, they are different in ways that will likely affect all of us through their tax, economic, and foreign policies. However, history has shown that while elections are incredibly important for all Americans as taxpayers, voters, citizens, it's also shown that it's important to keep a level head about elections when it comes to the stock market specifically. That's because the stock market has performed well over the past century under a variety of different presidents and parties. Any sort of reasonable analysis shows that there is no combination of political parties for the White House, Senate, and or the House that has averaged less than 10% in annual total broader market returns. In other words, from a stock market perspective, there has been, historically speaking, no compelling reason to believe that one party or the other will directly cause a boom or a recession or a stock market crash. And while it might feel like this time could be different given how polarized the country is at the moment, I would again reiterate how important that it is that we keep emotions out of this particular arena of investing. We got to stay disciplined. So, presidential elections are obviously very important politically, but they can also be a distraction to investors. The 2020 election will in the end likely be no different. When it comes to statistics and graphs, some of the simpler statistics of stock performance by political party, I have, I guess, a little pet peeve in that from both sides, it often overlooks the impact of the economic cycle on those results. And that causes sort of skewed results to be put forward, again, by both sides. And then you also want to remember that the policies take time to implement. So in this slide, those results were lagged, which is more analytically appropriate. And the whole point is, it shows that there's really little difference over time for either party. Another view of actual data in this one, while there is some difference between election and non-election years, that the difference is small, and all years show positive average returns. And then on the right-hand side there, and then once you exclude 2002 and 2008, which had little to do with elections, you can further see how little difference there is between years and parties. One more slide making the same point here. Look, the differences are not anywhere near as big as either party would have you believe. Now, this does not mean that there won't be any stock market volatility around election day, of course, or that sound economic policies should be assumed from any random candidate. What I am saying, though, is that the data over history shows us that the stock market depends on many other factors besides who happens to be in control in Washington, D.C. And I get it, that fact may be hard to reconcile for investors belonging to either party. Politics, especially these days, seems to affect so many different parts of our lives, which makes it pretty hard to separate those sort of feelings from our investment portfolios. But we also feel pretty strongly that you're all paying us to do just that sort of thing for you. And having the discipline to separate emotions from investing, really now more than ever, it's a critical ingredient to long-term success, regardless of what may be happening inside the Beltway. I think it's also worth remembering that look, investors in the broad market are often just flat out wrong about the impact of presidents and their policies. You may remember it was generally accepted leading up to the 2016 election that a Trump presidency would result in an immediate economic crisis and stock market crash. Well, not only did that not happen, but the stock market proceeded to make new highs. The same is true during the 2008 and 12 Obama re-election campaigns, when it was argued that having a Democrat in the White House, and also later the Affordable Care Act, would tank the stock market. Well, neither of those happened either. So, yeah, investing is supposed to be difficult, and one reason why is because what you should do is sometimes so contra to what you feel. And it is certainly the case that specific policies can affect individual industries and companies and sectors, especially when it comes to taxes and international trade. But when it comes to the stock market and the economy and national sentiment as a whole, the overall trends of the business cycle just matter much more than any individual who happens to be in office. And at the moment, the business cycle looks like this. You can see the current cycle over on the lower right-hand side there. It's tough to go through, but I think looking forward from today, I think that bodes pretty well for investors, regardless of who may be in Washington, D.C. Now, to be clear, I think it bodes better for some investors than others, but, hold that thought for now, at least until the next video. My point here is that you should not let anyone in politics on either side deter you when it comes to being invested for the long term in American companies. I'll close with this thought. Uncertainty, it is a necessary prerequisite to achieving attractive long-run stock market returns. Without any uncertainty, then everyone would invest, which would drive up prices and drive down returns, right? So although this next month may be fraught with uncertainty, it's also clear that many parts of the economy will continue to recover over the same time period. And then longer term, history has been pretty unequivocal. It's a mistake to bet against the U.S. market, which over the long term looks like that, up and to the right. So look, I'm not guaranteeing this next election will be uneventful, or that there won't be any volatility in the market on or around November 3rd. What I am trying to say, though, is that for long-term investors, which I consider us to be here and you all to be out there, any market volatility around the election will number one, it'll be a blip on the horizon a bit further down the road. And then number two, it's not necessarily a bad thing either if we can take advantage of anything that might go on sale because of it and then stay patient on the other side. That's it on video 1, the big picture. Stay tuned for the next video on energy specifically in another week or two. Any questions or comments about anything in here, please fire away. You've got my contact info as usual. And then I'll also post this video on the boards, on the IIM message boards, for those of you on there too. Okay, thank you for your time, and more soon.